Hello and good afternoon. Moneycontrol wishes all its young readers and viewers a very happy Children's Day. And on the occasion of Children's Day, we have a very special gift for you all. We have with us Nithin Kamath, CEO and co founder of India's largest stockbroking house, Zerodha. We welcome you, Nithin.
Hey,
And he's going to
thanks.
share with you all some of his Yeah, and he's going to share with you all some of his money mantras. So to start with, Nitin, could you tell us like what was your relationship with money while you were growing up?
Yeah, thanks, Bhavya, for having me on this, and happy Children's Day to everyone. I don't know how many kids are watching, but I'm sure parents are. But yeah, money mantras as a kid when I was young. I mean, I think I was. I think I've grown wiser with age. When I was younger, I think I was trying to make money quite early in life. So I started trading and working when I was 17, 18. So as a youngster, I think I was a lot more aggressive in how I manage money. But I kind of learned over time, and I think starting early in life, meant that I learned a lot of my money lessons, making smaller money mistakes. So yeah, I think the mantra is to get started quite early. So I mean, I think it gives you an advantage, in your life of sorts.
Right, right. So you started actively investing in the stock markets when you were 17, and you told in one of the interviews that you were living in a Marwadi neighborhood and you made friends with them, and that's what influenced you to start investing in stock markets. So, how was the experience like? What were the initial mistakes you made, and what were the learnings that happened over the period of time?
Yeah, I think, I mean, the experience has been like a roller coaster. It was quite volatile. There were periods where I made money. There were periods where, I lost money quickly as well. But the money lesson, I think, I don't know when I was young if I was smart enough to understand the lesson, but like I said earlier, I've grown wiser with time. I think the lesson really was that, it's very hard to put a money goal and try to chase it down. I think the idea has to be to find something that you like to do, and get better at it. And I know in today's capitalistic kind of a world, if you get good at something, money really automatically follows, right? And uh, because if you put money goals in mind, what happens is you optimize all your decisions to make money, and then you can compromise some basic things required to make money in the process. So I think as a youngster, the idea is to find something that you kind of like love to do, and give your time and effort. If you get good at it, eventually money will anyways follow. And I think that has generally been my life lesson. And even today when I look at my son, I'm trying to help him discover what he loves to do in life, and without really keeping any material goals in mind of sorts.
Right, right, right. So it's basically the similar lesson that Three Idiots gave us in the end, that Kamyab bano and then the success will follow you once you are skilled and proficient enough yourself. So you're talking about giving money lessons to your son. So how do you think the relationship with money has changed over a period of time? Like what your relationship with money was versus what his relationship with money is in today's time?
Yeah, no, I mean, the thing is, he is still 7 years old, so I don't think he really understands the concept of money yet. Like I said, I'm not even trying to bother teaching him about money. Right now, the way I think about him is to help him discover, what he loves to do without influencing him into it. Like for example, as a parent, it's very easy to want your kids to do what you wanted to do in your life, or what you had, like for example, I've always wanted to play good guitar. So now, instinctively I know that I want Kian to pick up a guitar and start playing good guitar, right? So in a way, I want to be enforcing my choices on him. I mean, the whole objective here is to not do that and let him discover. So I'm not still bothering to teach him about money lessons, except for except for not taking money for granted, because being my son, it is possible that potentially can take money for granted in the future. So I kind of constantly tell him I mean, the concept of money in terms of like the fact that it isn't easy to earn money, and and I don't think you should uh, kind of qualify your friends and people that you hang around with based on how much money they have, etc. So I mean, very basic stuff, But yeah, but apart from that, the focus right now is to help discover, um, you know, what you like, love to do, and I think most kids, you should use the like whatever the younger days, right, until you kind of reach the adulthood to kind of experience and discover things.
Right. So once the kids are between the 9 to 13 year of age, they can still figure out, experiment with things, explore more things, learn skills. But once they reach the age of 18 and they're starting college, they are starting to ascend to their adulthood, and they might have saved pocket money over the years. They might be getting pocket money for their college expenses right now from their parents. So how do you think like they should figure out the balance between spending, saving, and investing once they're 18 and above?
Yeah, I mean, this is something I've been trying to talk about quite a bit, saying when today's younger generation are gonna be like 40 or 50 years of age, I think the medical progress would be so much that uh, like average age life expectancy would have gone up significantly. Between I think 2000 and 2019, the average age life expectancy has gone up 6 years. So, by the time it is 2040, 50, potentially it could have gone up another 6 or 7 years. So, the average life expectancy of humans could be like 75, 80, somewhere in that range, right? And the other thing that's happening is, because of technological progress, people's retirement ages, like, because, if you're not constantly upping your skills, you can suddenly become redundant, right? As in, because technology is evolving so fast that a lot of jobs keep getting lost every time technology just makes the entire process more efficient. So I think one of the problems in the future is that people will kind of forcibly be retiring, like earlier than 60. So potentially people retiring at 50, and then the average life expectancy is 80. So so there is a 30-year funding gap. And the only way to kind of get around this is to start saving early, and this is something I keep talking about, whether there's an opportunity that uh, people should start saving as early as possible. And I'm not saying that you shouldn't lead your life, but uh, I think if you have an option to kind of spend money on experiences, I think people should, because experiences is what helps you grow intellectually. So when I'm saying experiences, I mean, like, if someone thinks he likes music, go spend on a good teacher, try to learn music. Someone wants to get into fitness, find a good trainer, learn. I mean, because these things are net incrementally, they add value to you, to you as a human, right? As a person. So I mean, kind of going there, or spending on education, and etc. It makes sense. So, but when it comes to material expenses, right, as in spending on things which are depreciating in value, which is like a mobile phone or a car or a bike or whatever, I think people should kind of mark a certain budget, and not really extend over it. I would say not more than 20-25% of whatever people get money should be spent on material things, and if you make this as a habit when you're really young, as you grow into adulthood and as you start earning money, and as you get your jobs, etc., so then it becomes a second nature. Otherwise, what happens is, in today's world, there are so many people triggering you to buy things that you don't really need. So unless it's a habit that you've inculcated from when you're young, it's very easy to get carried away and buying things on credit, which you potentially don't even really require. So yeah, so I think the trick is to start early and start saving, and make it a habit. What you save in is secondary. The habit of saving is very is important to be started quite early in life, I think.
Right. So starting early is important because that's what gives you the magic of compounding over the years, right? But also, then you said like what you invest in is secondary. But many people who have just maybe graduated college are first time earners right now, they would not know what products to get into while they're starting off. So, what are some of the products that you think teenagers and also young adults can experiment with or explore into to build their portfolio right from an early age?
Yeah, I mean, I think it should be, start off with a bank fixed deposit, the easiest thing to do, right? As in, because the thing about saving and investing is, if people start, investing into mutual funds and stocks, what happens is, if you see a drawdown, right? As in, if you see some money being lost, the chances are of people not doing it at all. I mean, say assuming, I had 20,000 rupees, I saved into some mutual fund, it lost, say, 10%. Markets go up and down, so there's no control on, the timing, the mutual fund, etc., right? So people can stop, investing for the future. So my usually, I say that, if you're young, you don't know about stock markets or mutual funds, etc., idea is to just start off with a fixed deposit. Once you have a certain amount of capital, then maybe a small portion of it you can start investing into mutual funds, and start a SIP or something like that. So assuming, I'm an 18-year-old, I think my objective right now is to save 50,000 rupees, and that 50,000 rupees, save it in a fixed deposit. And once you have 50,000 rupees, maybe start a 2,000 rupees SIP per month, and pick up an index fund, which is low cost index fund, and start investing monthly, after that. And because you're doing a SIP and you have a 50,000 kind of like a fixed income, so your chances of getting perturbed when markets go down, etc., is much lesser. So which means that if you start this as a habit, you wouldn't just stop it because the market, gyrated down or something like that. So it's so yeah, so it's my advice would be to kind of start uh, investing into mutual funds, and like start with a fixed deposit and then maybe into index mutual funds. Bhavya, you're on mute.
Yeah, so sorry. So, okay. So, also, we spoke to a lot of first time earners for a series of stories that we are doing. And what we came across is that a lot of youngsters think that these mutual funds or fixed deposits are boring and they want to invest, like directly explore direct equities or something like crypto. So, how should they balance that experimenting urge versus that safety urge of and building that financial security and wealth creation in the long term?
Yeah, no, the thing is, I think the one of the important concepts to learn quite early in life is around risk to rewards, right? Is that
Yeah.
if you want higher rewards, you need to understand that you are taking higher risk, right? If you, for example, I think, amongst all of these things, probably crypto is the most risky, right? As in, and you've seen what has happened with crypto, right? As in, it went from $10,000 to say $70,000. It's back to whatever $15,000 as in Bitcoin, right? As in, so in the sense, are you like a person who can actually handle this volatility? I mean, that's a question I think youngsters should ask themselves. And the second thing is that I think the one of the most important skill sets required to do well with the money is money management itself. I mean, not just to just not just your personal money. I think it also extends into running a business as well, right? As in, running a business, trading, they're very similar in the way they work. So it's about deploying your resources where you can potentially have the most predictable income of sorts. And so yeah, if someone's getting tempted into doing crypto and direct stocks, i wouldn't I wouldn't stop that person from doing it, because that might end up creating this curiosity, and then which might extend into learning more, etc. So I would say, think of the risk. The higher the risk, allocate the lesser portion of your net worth or your portfolio. So yeah, so if I'm getting really tempted to do crypto, and because I know crypto is something which can kind of either go 5x or lose 90%. So probably in that 100 rupees that I have, or say 10,000 rupees I have, I'll say, how much money can I afford to lose completely? Say 500 rupees, and then probably potentially 5% of that, which is 5% of 10,000 rupees, I'll go and put it in crypto, right? Now stocks are much less riskier than crypto. So if I'm really getting tempted, I would say, allocate another 25% to crypto, stocks, direct stocks, and then go invest into stock markets, right? As in, and within this, when you start investing in stocks, the idea is to always diversify, because a lot of people think you can buy one stock and somehow make money. The important lesson about money management and investing, etc., is that if you make money the wrong way, right, you tend to give it back in the long run. right? As in, so if you're someone, who wants to pick a single stock and try to, kind of hit it out of the park all the time, yes, you might invest 10,000 rupees, which becomes 1 lakh rupees, and in one stock. But that, eventually, that, that trading, that investing habit, you will continue. You'll probably potentially put that 1 lakh rupees in another stock, which loses 90% in value, right? So because, every time you pick up single stocks, you're taking, you're exposing yourself to a large amount of risk. So diversification is absolutely key when investing in the market, and you're thinking of this as a long run, as in there is no, if you're saving, investing, you're essentially doing it for your retirement, right? As in, so you have to plan it, saying that for the next 40 years or 50 years, I need to be doing this. So I need to do it such a way that my investing behavior remains consistent over the next 40, 50 years. So diversification, but I wouldn't, I wouldn't advise people to kind of, if they're getting tempted by crypto or direct stocks, to go put all the money into it. Only put money that you can afford to lose. Understand this whole risk to reward kind of a framework, and also understand that if you made money the wrong way, you're most likely going to give it away very quickly. So.
Right. So basically, crypto should be left only for the mad money, which you're okay with losing. And when we talk about investments again, so once someone is putting money through SIPs into mutual funds, that still people, youngsters whom we talk to, think it's an easier way to go with. And again, but if you are investing into direct equities, you need some kind of fundamental and technical knowledge to be able to invest in a particular stock that you are liking for any XYZ reasons, right? So how do you think people at a young age, when they're 18 and above, again we are talking about the teenagers or the first time earners, how do they equip themselves with the personal finance knowledge to be able to handle their finances and investing well? Because we are living in a world of social media, and all these people listen to influencers a lot. So what is your take on that, how should that learning curve be like?
Yeah, no, I think. See, the first thing is, one of the problems with this influencer crowd has been that they've made it seem like it's very easy to make money in the stock markets, which it isn't. I mean, we are in the middle of a bull market. There is a saying, right? As in a bull market, even a fool feels like is extremely smart types. So because everything goes up. So over the last 2-3 years, we've been in a one of those once in a lifetime bull markets of sorts. So yeah, so I mean, it isn't easy to make money, right? As in investing directly into stocks. I think the right stepping stone here is start investing in maybe index mutual funds. Once you invest into index mutual funds, you'll probably start picking up Economic Times or Moneycontrol or whatever, right? As in, you'll start tracking capital market, the news on capital markets. When you start tracking overall economy, you potentially might fall in love with one sector, right? As in, you might get a liking towards the sector. Like, for example, because I started trading early. I started tracking financial services firms very early in life. What are banks doing? What are brokers doing? What are NBFCs doing? So like that. So people might have a job, say, in a tech company, and you might start kind of tracking all the tech stocks which are listed on the exchange. Right? And once you have an understanding of the business, is when I think you should really be investing directly into stocks, right? As in, this whole stock tips is really, I don't think anyone's made money trading on stock tips in the long run, right? As in, because the thing about stock tip is you're it's like spoon feeding, right? As in, you might enter because I told you to enter, but you will not know what to do after that, and incrementally you're intellectually not better off because of that stock tip as well, right? So yeah, so I think the objective, especially since it's Children's Day and we're targeting teenagers, the idea is not to think of stock market as some place where you can quickly make money. Think of stock market as a place where, compounded over a long period of time, you can turn out okay if you follow like basic fundamental rules of money management, right? As in, and you can't just pick it up on one day. I mean, like, if someone at 25 is doing a software job, he's spent like what, 13-14 years in school and then in college education before he gets that job, right? So how do you then expect, like, first day of trade, first day in the stock markets, and you suddenly start making money? It's really hard to be like that. So yeah, so I mean, and I don't think everyone's even made to invest in direct stocks, right? Because, like, if I like, say, football, I mean, if you force me to play cricket, I might not like cricket. Or if I like cricket, if you force me to go learn music. I may not like it. So not everyone has an innate liking towards stock markets. I mean, the only reason I think a lot of people get pulled to the stock markets is because of greed. People assume that it's easy to make money in the markets, but kind of in the longer run, I think it's kind of obvious that if you want to, if you want your savings and investments to do better than inflation, I think the best bet even now is really investing in the best companies, because best companies in the country will tend to do better than inflation, because and in turn, in the long run can generate more money than what your bank fixed deposits and kind of can generate. So I think investing in the markets is important, but I don't know if everyone should invest in stock, direct stocks actually.
Right, like it takes deeply well researched and years of reading and learning to be able to reach that capability to understand the markets that well, right? So apart from this, also one thing, when you started investing at the age of 17, you said that you blew up when you were 21. It was during the time of the IT bubble of the 2001 2002, the Y2K crash, right? So and that you said that that's when you learn most of your money lessons from, rather than trading and investing. The blew up taught you more things, right? So, and also one thing that came out of that, that you should never borrow money and invest. So, and you said that trading and investing and building a business works in a similar way, and you have followed that in your business till date. So what advice about credit do you have to give to the teenagers or the young adults, or that credit might be in terms of taking a loan or even taking a credit card? So people think it's good if they take that at an early age and build a good credit score, but how to again maintain that balance in terms of the credit score as well?
See, thing is, I think the world's progressing so fast that to get a loan, if you need a loan in the future, people today are looking at your how you pay your telephone bills. Like your credit rating is not really just made out of credit score today, as in it's. So I don't think people should take a credit card and just use it just for a credit score, because the way all these NBFCs are proliferating, and in the sense all these new NBFCs that are coming through, they are going to most likely give you a loan just based on your normal behavior of of paying your bills on time, etc. So the thing is, I have a kind of a very conflicted view on credit. I think people shouldn't borrow to buy things that depreciate in value, right? As in, so for example, if I want to buy a phone, or if I want to buy um, you know by anything which doesn't incrementally add value to me, right? As in, so but say, yeah, if you were to buy a two-wheeler or a car on credit, and this helped you save some time during the day, which in turn helps you become a better human, then it's adding value to you. So I would say, credit for that is okay. If you want to borrow money to go learn something, it's okay, right? As in, because you're gonna become a better person because of that, right? But borrowing money to pay for samosas and or phones and etc. The incrementally it doesn't really add value. And what I think everyone needs to appreciate is that we live in a world where everyone's going to trigger you to borrow to buy things that you don't need, right? Because it could be your friends through social media, it could be all the platforms where your data is available, right? As in, all of these guys know the trigger points to push you to borrow money, right? And so to resist that temptation is very important, I think. Like, even when I was younger, I had my first credit card when I was working in a call center, and I used it to pay my GMAT fees. And it took like 2-3 years to clear that. Just interest, it just kept compounding, because one small mistake and the credit costs just go up so much. So I don't know if youngsters should even get exposed to this. Maybe credit card as you grow older, when it becomes a necessity, because if you're doing international travel, etc. Now credit card becomes kind of almost like a necessity. But I would advise that to avoid credit as much as possible, because not having credit is freedom, which is, I think, more valuable than money itself. So, yeah, Bhavya, you're on mute again.
Value, but you said that borrowing for buying a house, like taking a home loan does make sense. So how do you think about it?
Yeah, I kind of lost you there, but what if I had to guess what you're saying, you're asking is borrowing money to buy a home okay? I think home gives a sense of security and safety. So I think everyone, that we all feel very secure if we have a home of our own. So and that's valuable because that can incrementally help you do better in life. So and it's also very hard to in today's world be able to buy a home without a loan, right? As in, if you're salaried, etc., it's almost impossible to be able to buy a home. So I personally think home loans incrementally add value to you because it gives you a sense of safety, security, which can help you do better in your real life as well. So home loans are definitely something. If someone thinks that having your own home is going to make you feel comfortable and safe, I think borrowing to kind of have that is not a bad idea at all. So but if you already have a home and you want to now kind of borrow money to um, say speculate on real estate, right? And just because someone is giving you a low cost interest loan, I'm not sure if you should be doing that, because real estate, like stocks, right? As in the prices of real estate can go up and down. Currently we in the last 3-4 years, as you've seen, real estate has plateaued. But historically, real estate has done well in India. So a lot of people think real estate will always do well, which is not the case, right? I mean, real estate is like, is an asset class, just like stocks or just like gold. So it can go through, long up and down cycles. Now, if you borrowed money at a cost, and if real estate prices don't go up, it can it can potentially not work out very well. So yeah, so like I said, real estate, if it makes if it is like a first home which kind of creates a sense of safety, security, then yeah, real estate is a good idea. But I'm not sure if people should borrow to speculate on real estate as such. Okay, I think we've lost Bhavya. Okay. Yeah. So yeah. So if I had to give kind of a parting advice to youngsters, and I would say think of this as like a long term plan, as in this whole investing isn't really, I mean, you're not really trying to make a quick buck here. As in, if you're saving and investing, you're doing it as a retirement plan. So the idea is to inculcate good habits, because good habits will take you through the journey. Bad habits, it might in a short run kind of help you do well, but in the longer run, it'll come back to bite you for sure. So yeah, so the idea is to inculcate good habits. So start saving early. If you're spending, just make sure to spend small amounts of your, whatever you earn. If you're on credit, try to borrow money only for things that appreciate in value. And yeah, and I think constantly be curious and keep experimenting. So as a kid, I think we are all like that. We constantly are curious about things. As we grow older, we tend to stop being curious. So I think
Right.
it's very important to remain curious through your life. So yeah, so I mean, I think these are some of the advice that I would have for everyone.
Right. So again, being curious and being and inculcating those habits at an early age is really important. Again, when we are again talking about people who are teenagers in their end years of college right now. So how do you think that they can prepare themselves for the job market out there? Because we are seeing worries of inflation, we are seeing worries of recession, we are seeing layoffs in the industry, whether it's in the US, whether it's in India. So how do you think that they can be better prepared for the job market and financially prepared as well once they enter the job market?
Yeah, see, the thing is, I think good people, there is always going to be demand. I mean, if you're skilled in something, there will always be demand for you. I mean, no matter recession, no recession, right? As in, so really, when you're in college, like I said earlier, the idea is to find something that you like, love to do, and then kind of spend some time and get better at it, right? Because it could be anything niche, I mean, it could be like anything, it could be even hosting a podcast, for example, right? I mean, if you like hosting a podcast, do it often, get better at it, and then if you're good at something, you'll have a lot of opportunities. So the idea is to figure that. Now, I think it's very hard for someone in college to be financially prepared, because you're not really. I'm guessing most people aren't really making money when they're in college. But post college, when you start working, I think we just have to follow the similar rules that we spoke about earlier. Just start saving early and start not spend as much as as you're tempted to spend of sorts.
Right, right. Also, what would be your advice to the people who want to build something of their own? People who are in their early 20s and would want to start their own venture at an age of 24, 25, like early 20s only, because you started without borrowing, without investors being on board, completely bootstrapped. So, what would your advice to those youngsters be who want to start their own venture 2, 3 years down the line?
Yeah. See, the thing is, building a business is extremely hard. Over the last 3 4 years, this whole startup boom, right? As in, it's almost made, people have made it seem like it's easy to do a business. Business is, really one of the hardest things to do. Getting people to pay for you a product and services, right? A lot of people assume that building a business with a certain valuation is equal to building a business, which isn't true. As in, a business is really a business when it starts generating positive cash flows, right? As in, which is whatever's money in, what you make out of it is more than the money which has gone in, right? As in, that really is building a business, and that's really, really, really hard, right? So while there is a lot of today, like entrepreneurs are look like almost like heroes. So everyone wants to be on the other side, but the other side is really, really hard. So I think the way youngsters should think of building a business is that unless you come across a problem statement, right, as in that you kind of associate with, right, because every business is trying to solve for some problem, right, as in so I think as a your step to building a business should be you come across a problem statement that you associate with, and then you kind of build some bare minimum skills required kind of to build on that, right? As in, because I keep saying this, is that before you go chopping wood, you need to sharpen your axe, right? As in, so before now that you found a problem statement that you associate with, you can't just get up next day morning and say you want to build a business if you don't have the skills that is required to build a business. So I think the next step then is you go find a job, work a few 1 or 2 years in that industry, try to get a core competency on how the industry sector works, right? And maybe then think of building a business, right? Because your odds of succeeding increases exponentially then. Like, one of the reasons I think Zerodha has done well is because some of us who've been very core to the business, we've had like almost like 5 to 10 years experience before Zerodha, right? So all those learnings from before Zerodha has helped us, I think, do better as a business, which is so yeah, it's been extremely key in the growth of our business. So if you're looking at starting up, don't hurry into it. Starting a business is like almost like getting into a marriage, right? It's very hard to get off it if it's not a good marriage types, right? So it's you can then have opportunity losses, etc. Wait till you come across a problem statement that you love, or associate with. Give a couple of years around building core competency of this problem statement, and then maybe think of building a business.
All right, all right. Also, like if you could share with our viewers, because most of the viewers would be teenagers and youngsters, some of your personal stories that made you learn the most, like whether it was from your teenage years of trading or you working that call center job or now working at Zerodha. So, what have been the major anecdotes in your life that have made you learn the most?
Yeah, I don't think there is the one item. So I was a very bad kid in school. I was really, the last, in the class almost through my life. But I think there was one thing I think, looking back, I've done right, which is accidental, is that I think I've generally been quite a curious guy, and I might not have specialized in anything, but I've been like a jack of all trades. I play a bunch of sports. I've attempted a bunch of musical instruments. Like I like reading diverse stuff. Like different genres of music. And so the thing is, I think, all of this incrementally, every time you're trying to learn something new, something different, read something new, something different, intellectually you're slowly and steadily kind of improving, and that compounds with time. Like I said earlier, I think one of the when I look back at some of my school friends and college friends, I think a lot of them stopped being curious at some point in their life, as in, like as soon as they got their first job or whatever, right? As in, then they got into the rat race of thinking about doing everything for the money. And I think I've generally remained quite curious in life, and I think incrementally that has just constantly helped me kind of slowly and steadily keep getting better over time. So not only does money compound with time, if you have invested in the right places, but I think if you invest in yourself the right way, you yourself compound with time, and I think that really has to be the objective of everyone. And it's easy to do it when you're young because it becomes a habit. It's harder to do it when you're older because inculcating such a habit when you've lost track of it, and you've not done it for a while, it's much harder.
Mm-hmm. Right. So again, like I see a code behind you that all you touch and all you see is all your life will ever be. So how does
Right.
that work in your life? Have you incorporated that? What meaning does
Yeah.
it have for you?
I mean, that's a Pink Floyd song. So, I mean, it's from a Pink Floyd song. Yeah,
I
but a friend, kind of gifted that thing to me because it is exactly what I just told you, right? As in, which is, the more things you experience in life is really, how your life evolves into, right? As in, so yeah, so it's the idea is to just get up every day and try to keep experiencing and just be more curious in life.
Right. Also, again, one more question: like, is it good to be curious and risk taking at an early age and experiment with things when it won't impact your life majorly, and you would be invested with small amounts of money, and go in fully in and take those risks and experiment and learn, or not do it early, be conservative, and have that urge still when you are in your 30s and make those mistakes then?
No, I mean, I think any mistake is better made when you're younger, because the impact of that is going to be much lesser. And I know I've said this before that the silver lining of the bull run from the last 2 years has been that most people who have come into the markets are much younger. The average age is probably 25, 27, somewhere there. It doesn't of the new people who join, and and the good thing about the younger population is that I think a lot of people have invested because of peers and influencers and stock tips, etc. So which are all wrong habits. But I think these money mistakes, people will learn because of the money mistakes. And the good thing here is that the money mistakes would have been made on small amounts of capital, right? Historically, in India, the bull markets, you typically had older people come in with you know a lot more savings and etc. So the impact of money mistakes would have been much larger on their personal lives. So with the younger audience, it's going to be much lesser. So while I'm telling that people should diversify, they should probably not do stock, more than 1 or 2% of crypto, or 10-20% of stocks. Everyone gets carried away, right? As in, it's not like I followed all the rules in my life. So yeah, but the idea is to do something and not sit down and put money in gold or real estate, and and do nothing else in life. I think it's important to kind of go and invest money. I mean, it could start with fixed deposit, but I think you have to extend into equity markets in some way. And starting early is really it gives you a lot more freedom, and you like I said, this understanding of money and how to manage money, etc. That skills also helps you in doing well overall as a life, as your life is.
Right. So overall, in the entire discussion, we would have many a times reiterated this, but okay, one last time, if you have to tell that one big investment mantra that you think can make someone financially free, what would be that?
Yeah, I mean, start as early as possible, make it a habit, don't borrow unless it is, it incrementally adds to your, the quality of your life. And yeah, and manage your risk well, which is, keep diversified. Don't put all your eggs in one basket. I think this would cover it all.
Right, right, right. All right, Nitin, thank you so much for joining in. And I'm sure that all the youngsters watching this and even the parents watching this would have had a lot of points to take away from this discussion. And they would like to inculcate those habits in their children, or those teenagers and young adults would like to imbibe some of the points that you mentioned here today. So thank you so much for joining us and sharing some of your money mantras on the occasion of Children's Day. And yeah, thanks a lot.
Yeah, 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 thanks, Bhavya, and happy Children's Day again. Bye.
All right, wishing a very happy Children's Day to all our Money Control viewers. Thank you.